Hi, everyone. So welcome to the stream today. Very much excited for having you on the part 2 of our treatment of IAS 12 income tax. Yesterday, we started with a discussion and we looked at the various things that we need to discuss, the core definitions that we need to look out for, the objectives of the standard. We came to look at the 4 components that are entailed or that are included in the determination of the income tax of an entity in the income statement for the year under consideration, and we saw how we deal with the over and under absorption of tax. We looked at how current taxes are dealt with, and then we concluded the day yesterday on dealing with the issue about deferred tax and look at the various double entries that we need to look out for. Remember also that we discussed the issue about the preparation of the income tax account under the income statement and other comprehensive income, and then how we prepare the income tax account when preparing the statement of the cash flow in accordance with IAS 7. And so these were some of the things we discussed, and we mentioned that we'll be continuing with the discussion today to look at the movement in deferred tax as well as solve some questions and find out how the various treatments will be done and how we will be looking at the entries that will be made in accordance with IAS 12 about taxes. So I see some of you guys joining. When you join the stream, consider to give us a thumbs up on the video. That way we get more engagement on the video. That is what a YouTube algorithm wants, and we will be able to get the video to reach as many students as possible so that together we can build this channel and take it to the next level. So thank you very much for joining the stream. I see some of you with a thumbs up on the video. Thank you very much. And then some comments coming in here. Now, most importantly, we are arranging these live streams based on the questions you ask, based on the topics that you want me to cover, based on the things you want to see on the channel. So if you are watching the stream and there is anything you want me to teach, don't give me subjects, okay? Give me topics. Tell me the topics you want me to cover on the channel. That way, we add that to our topic list. We prepare content of that for that. Then we'll be able to organize a session like this so that I'll be teaching. So maybe you are saying that, Nhyira, it's like you are doing a lot on financial reporting, corporate reporting. How about the other subjects? If you have any questions, any topics in the other subjects that you would want me to cover, please put it in the chat box. I would want to hear from you. I would want to know the topics that you want me to cover in the other subjects as well. And who knows, maybe tomorrow or something like that, I might be touching on your topic and I might be talking about it. So thank you very much. I see couple of you as well joining. Welcome. When you join the stream, give us a thumbs up on the video. When you join, give us a thumbs up on the video. Thank you very much for the thumbs up. Hakim Kana, I see you. My good friend, how are you doing? I'm doing well, Hakim. I hope you are also doing well. Mustafa Tunkara, hi, I see you, Mustafa. Oluchi Inonwa, I see you. Good evening. I hope you're doing well. Then please, which level is this? Okay, this is IAS 12 income tax, and it's applicable for financial reporting as well as for corporate reporting. Then Christiana, I see Edu said, hi, Nhyira. Hello, Christiana. I hope you're doing well. Martinez Ado said, practical questions on IAS 2 inventory. All right. So, and then Gabriel Goku, I see you, Gabriel. Welcome to the stream. So comment in the chat box the questions, the topics, okay, you would want me to cover. So I'm getting IAS 2. Let me add that to my bucket lists here. Let's see. Some song notes. That will be under topics. Let's see. Okay. So let me add that real quick in real time. So IAS 2 practical questions. Practice questions. Okay. So that is added, and we'll be looking at it as we continue. Donnie Jamila, watching from Zimbabwe. Hi, Donnie. I hope you're doing well. Domi, sorry. I hope you're doing well. Lamidu Lams, he said hello from Nigeria. Hi, Laminu Lams. I hope you're doing well. I see some of you guys also joining. So welcome to the stream. Thumbs up on the video when you join. And then let's get into the discussion for the day. If there is any topic you want me to cover, like I said, don't give me subjects. If you give me subject that is vague, give me a topic. Nhyira, I want you to cover this topic. I want you to cover that topic. I want you to cover this topic. Once you give me the topic, I'm able to, we will definitely be able to know that the subject that you're talking about, and we will be able to fix time for that. So let's see. Mustafa said, I would like you to cover with us company accounts. Go through your channel. I didn't see lecture on company accounts. When you say company accounts, are you referring to like final accounts in financial reporting or in corporate reporting, or final accounts in financial accounting level 1? Maybe clarify that for me, and then I'll assist you well in that case. Laminu said, please, IAS 12 for leasing contract. IAS 12 is no more valid though. I don't know, is it in your course that you need to learn it? Because IAS 12 has been replaced with IFRS 16. Okay, IAS 12 has been replaced with IFRS 16. So Lamino, I don't know, is it in your course that you need to learn it because it's outdated? It's no more valid. Now we are using IFRS 16. For IFRS 16, I have a content on that already on the channel. You can check the accounting standards playlist and you will see IFRS 16. I think I did a 2-part video on IFRS 16 leases, and that can assist you better. But let me know if maybe in your course outline you are required to study it as well, because whilst I was teaching the IFRS 16, I also explained the concept of IAS 12 there. So you need to look at that account or look at that video to be able to go through it. But we'll be solving some questions around it as well as we proceed with our discussion. Then, okay, so Mustafa said final account of the company. All right, that is fine. We will look at that. Laminu said, no, I meant income tax. Okay, IAS 12. Okay. You know where my mind was? Where my mind was? Oh, my mind was somewhere. Laminu, forgive me, okay? My mind was somewhere. Somewhere. Yeah, IAS 12. Yes, income tax. That's what we are on. Possibly today we'll be covering some of those things that you are mentioning there. So let's see how our discussion goes today. Francis Oseipoku said, good evening, Nhyira. Many thanks for the good works. Please, where do I get your ebooks to buy? If you want my ebooks, then definitely you would have to go to Amazon. So the link is in the description to this video, or you can just get on Amazon and search for Nhyira Premium, and you'll see my books and get a Kindle versions to buy and be able to study for the exams. All right. So Francis, you can get a Kindle version of my books on Amazon. So go to Amazon. The link is in the description. If you want to, you can just go straight up to Amazon and then search for Nhyira Premium, and you'll be able to get access to that. Kana said, when will ICAG results be out? Yeah, we currently don't know when the results will be out, and we are still holding on to see what happens, but possibly any moment soon the results will be out. So just keep your fingers crossed and keep hoping for the best. The results will be out as and when it has to be out. All right. So Hakim Kana, just keep your fingers crossed. We're hoping that the results will be out as soon as possible. As soon as possible. For dates, I can't give you any dates because we've not been given any dates about it. So we just have to wait. Right, so let's build up from where we ended yesterday on dealing with the deferred tax. So if you remember, in putting everything in a nutshell, we said that the way the tax authority accounts for transactions will be different from the way entities account for the transaction. And we said that we defined a couple of key terminologies, one of which was the tax base of an asset or a liability. Then we said that the tax base of an asset or a liability can be defined as the value that is placed, or the amount that is placed on the asset or liability for tax purposes. Then I gave you an illustration that, for instance, if we buy an asset, in the books of the company, we will be depreciating the assets. Probably we're using the straight line method, or we're using the reducing balance method. So we're going to be depreciating the asset, and we're going to be determining the carrying amount of the asset, or if you want, the carrying value of the asset. Now, as the entity will be depreciating the asset, on the face of the statement of financial position, they will going to be putting the carrying amount on the face of the financial position. But for tax purposes, in the books of the tax authority doesn't know about depreciation. What the tax authority knows about is capital allowance. So whilst entities are depreciating the assets, the tax authority is granting capital allowance. So at the end of the day, we will determine the tax base of the asset, which is the cost of the asset minus the capital allowance, and compare that with the carrying amount of the asset. Once we have the tax base and the carrying amount, the difference between the two leads us or results into what is called the temporary difference. Then we said that this temporary difference is what ultimately results to the deferred tax. But we said that the temporary difference could be either positive or negative. We mentioned that where the temporary difference is positive, it means that the carrying amount of the asset is greater than the tax base of the asset. For that reason, it results into what is called deferred tax liabilities. Why? Because if your carrying amount is greater than the tax base, all other things being equal, should you sell the assets today at the carrying amount, it indicates that when filing capital gain tax, you're going to be making profit per what is recorded in the tax authority's book for the tax base of that asset. So that profit potentially that you are going to be making is what results into a deferred tax liability, which you are supposed to provide for in the financial statement. But we mentioned that where the carrying amount is less than the tax base of the asset, that results into deferred tax asset. Why? What it means is that should you sell that asset today, should you sell that asset right now, you're going to be making a loss. And when you make a loss, you're going to be taking a tax deductible credit from the tax authority, and that ultimately reduces your tax liability. So that was what we mentioned yesterday, and we saw an illustration of how this computation can be done. But one of the things that we did not highlight yesterday was the fourth component. Remember, I listed 4 components here about what it's included in the income tax of an organization for the year under consideration. So number 1, we said that over and under provision of tax, and I mentioned to you how you can do that, how you can determine that. In case you missed that, the link to that video is in the description of this video, and you can watch that as well. Then we came to the current tax. Then we discussed what? The deferred tax. Now, the final slide we want to add is the issue about movement in deferred tax. So where there is movement in deferred tax, what does that mean? In a simple language, we say that movement in deferred tax results into simply computing the deferred tax for the first year and computing it for the second year. So the deferred tax brought forward minus the deferred tax brought down, that is going to be resulting into what? A movement in deferred tax. Note that the movement in deferred tax again can be positive or can be negative. In other words, if your deferred tax liability goes up, the opening balance is less than the closing balance, that results into an additional deferred tax expenses that is going to go to the income statement of the organization. However, where the opposite is true, then that will reduce our current tax liabilities for the year under consideration. So these were the things that we mentioned last week, and now we want to build it up and look at movement in deferred tax. You ready? So give me a thumbs up on the video. I see some of you guys joining. Thank you very much for joining the broadcast. It's always a pleasure coming your way and wanting to help you and assist you for you to be able to prepare well for your examination. Give me a thumbs up on the video. Comment in the chat box with any questions that you have for me. What topics would you want me to cover in other subjects? Put them in the chat box. I'm reading all of your comments, and I'll be replying to all of your comments. And then if there are any questions you have for me, to drop them in the chat box. I would want to hear from you really as we continue with our discussion. So I see some people coming in. Kwachi Isaac said, Nhyira, I do get the question bank to buy. Nhyira, I do. I don't understand, Kwachi. Are you asking whether you can get the question bank to buy? That is the ICA question bank. Is that what you're referring to, Isaac? Kwachi, let me know. Gloria, I see you. You are welcome. Give us a thumbs up on the main video page as well. Azuga Moses, I see you. Eric Asomenin, I see you. Nicole Williams, hey Nicole, I see you. Gloria said, good afternoon, Nhyira. Good afternoon, Gloria. Any questions, put it in the chat box for me as we build up our understanding. So movement in deferred tax, movement in deferred tax. So like I said, movement in deferred tax simply has to do with where you are comparing the opening tax balance against what? The closing tax balance. And finding out, has it increased, has it reduced? It is that change that we take to the income statement or the P&L accounts, and the new closing balance is what goes to the statement of financial position. All right, that is we take to the statement of financial position. So let's get into the discussion. I'm going to put a guinea pig question up, illustration up. Then from that, we will use it to do the computation and find out how we can deal with what movement in deferred tax. And then from there, we will look at a question in the ICA question kit. This is the financial reporting ICA question kit or question bank. Remember, I told you when we started this series about 3 weeks ago that you've got to get this book because I'll be solving a lot of questions coming from this book in all of the subjects. I don't know, it's 40 cities or so, something like that. Okay, so Gloria said, where can I get your books to buy, please? Gloria, you can get my books on Amazon. So you can go to Amazon, you can go on Amazon, search for Nhyira Premium, and you'll find me. The link is also in the description to this video. Or better still, you can call or WhatsApp us 050-114-9296, 050-114-9296, 050-114-9296. If you are outside Ghana, you add +233 to that, and then you will be able to reach us. So you can WhatsApp or call us for any details about my books, and then you'll be able to get direction on that, or you can directly buy it on Amazon. Okay, so Chumesi Jeff, I see you. You're welcome to the stream. Give me a thumbs up on the video. Isaac said, I mean, how do I get it to buy in Cape Coast? Do you have the ebook? Are you talking about the ICA book? ICA book is sold by ICA. So I think ICA, they have a regional office in Cape Coast. Also, you can get it from Cape Coast. This book, there is no e-version available. It's not my book. That is the ICA book, right? So you can call the ICA and you get directives on how to get the books to buy. Okay, I hope that's what you are referring to. Gloria said, I need PSA and taxation. Please, can I get hard copies? Yes, my PSA book, we are releasing a revised version on the PSA book. So you can get both hard copies of the PSA and then the taxation on Amazon. You can place an order, delivery will be done for you and all that. Like I said, you can also call or WhatsApp +233-50-114-9296, and details of that will be given to you so you can get the hard copies as well. Okay, so Gloria, you can do that or get the hard copy directly from Amazon. That is possible. Okay, that is possible. Okay, Kwachi said thanks. You're welcome. So let me pull my guinea pig question up. You ready for that? Let's go. So example, let's see. KK Limited bought an asset for $25 million with an economic useful life of 6 years. Oh, let's do something good. Of 10 years. The entity can claim a tax deductions at 20% per annum, reducing balance basis. Reducing balance basis. Okay, so this is the information we have. It's a guinea pig question, and we're going to pick it up and then expand on it. You stay with me closely, all right? We're doing movement in deferred tax. It's one of the critical areas, so make sure you stay with me. KK Limited bought an asset for $25 million with an economic useful life of 10 years. The entity can claim a tax deduction at 20% per annum, reducing balance basis. Now, the requirement here is that we're going to be using the question as a guinea pig to look at how we deal with what? Movement in deferred tax. You ready? So let's go. So let's see how we go about it. So solution, definitely KK Limited. So remember, since we're looking at the transaction, remember the objective of IAS 12. What did we say was the objective of IAS 12? It is to prescribe the accounting treatment for income tax. However, it also states that in achieving the objective, entities must recognize the tax effect on transactions the same way they will account for the transactions themselves. So as you can see here, there may be nothing indicating that tax is inside, but as far as it's a transaction we are dealing with, IAS 12 requires that we deal with the tax consequences of the transaction. So let's say that NB, let's give the tax rate to be 25%. All right, so let's go. So number one, what do? We need to determine the carrying amount of the assets. So let's see what we do. Let's put our currency sign up with million in there. Let's bring the cost in 25. So let's work in thousands. All right, can we do that? Let's work in thousands so that the cost will become 25,000. Then let's bring the depreciation for the first year. So depreciation for year one. Remember, it's a straight line method, so that's going to be 25,000 divided by 10 years. And that's going to be 2,500, I guess. So the carrying value of the asset, or the carrying amount of the asset, as at the year ended year one, will be 22,500. You good? So that is the carrying amount of the asset as at the year ended year one. But remember, immediately you deal with the carrying value of the asset, what do you have to deal with as well? You need to deal with what? The tax base of the asset. So let's also look at the tax base of the asset and then how we knit the two together. So in dealing with the tax base of the asset, now, have you put this down so that I can clean this up and then work them out differently? Put that down real quick and let's go. Actually, the information there are real practical. So let's see what we do. So just scribble it down. Let's go. Okay, so as you are scribbling, see a comment coming in. Let me look at that real quick. Catherine Ramiche said, hey, Catherine, it's been a long time, eh? It's Catherine from South Africa. Yeah, I know Catherine, right? I passed my management accounting exams. Wow, congratulations. Thank you so much for your help. May God always bless you. You are amazing. I finished my degree. Wow, that is awesome, Catherine. That is very good to hear. Congratulations and wishing you the very best as you enter the next phase of your life. Very excited about it for you that you have passed and also finished your degree. That's a very great news. That is a very, very great news. So congratulations. We need to do some party, right? So hit me on Skype. Let's organize some Skype party. What do you think? So hit me on Skype. Let's do some Skype party. Niwas, I see you. Hello, Niwas. Welcome to the stream. I see some of you joining the stream. When you join the stream, you give us a thumbs up on the video. That way we get more engagement on the video. All right, so I hope you scribble this down. All we need is the deductible tax allowance, which is the same as the capital allowance, and then the tax rate, which is 25%. So let's get it done. So on one side, we're going to work on the carrying value of the assets. That is what the entity is going to be doing. Now, on the other side, we're going to work with the tax base of the assets. So again, we're working 3 zeros up. And then what do? We bring the cost of the assets. And that's going to be 25,000. So we bring capital allowance for the year 1. That's going to be 25% of, was it 25 or 20%? I think that was 20%. 20% of the 25,000. And that's going to be 5,000 if my memory serves me right. So that the tax base of the asset at the end of year 1 will be $20,000. So look at what is happening here. At the end of year 1, what's going on here? At the end of year 1, what's going on? At the end of year 1, you can see that the tax base of the asset is at the end of year 1, the tax base of the asset is 20,000, but the carrying amount is what? 22,500. So that result, or that leads us to something, as you know already, the temporary what? Difference. So we need to calculate the temporary difference. And the temporary difference, like we said earlier, will be equal to the carrying value of the asset minus the tax base. So our carrying value here is 22,500, and then the tax base is 20,000. Okay, stay with me carefully. Now, what do we have here? We have 2,500. That becomes the temporary difference. Now, like you can see here, you realize that we are getting a positive temporary difference. Now, when we get a positive temporary difference, what does it result to? It results to deferred tax liability. So, deferred tax liability will be equal to the temporary difference, 2,500, times the tax rate, which is 25%. So, what do we have for that? Let me grab my calculator. So no 2.5 by 2,500, that's $625. So this is what happens in the books of the entity for the first year. So in the books of the entity for the first year, what do we have? We have a tax base. Now that is not going to come in our books, but this is not going to be coming in our book. But remember, what's happening here? We are having what? A deferred tax liability, and that is for the first year. So let's prepare a financial statement extract, okay? So when we are preparing the income statement, so statement of P&L extract, what do we bring for the first year, okay? We bring the depreciation, maybe that could be under cost of sales if you want. All right, and that is 2,500. Then income tax will be brought, the deferred tax we calculated, 625. I hope you are getting the concept. So that is what is happening in the income statement. Then in the statement of financial position, if we want to extract that, we're going to put that here. We're going to have under non-current assets, we're going to have property, plant, and equipment. and that's going to be the carrying amount of 22,500. Then under non-current liabilities, okay, non-current liabilities, we're going to be bringing the deferred tax. So non-current liability will bring the deferred tax, and that is 625. So this is the extract financial statement we prepare for the first year. Now you can see that this is simple. A lot of things are not happening here. It's simple. We can pick it up and we can go our way. So put it down and then let's continue. Nawaz said, I'm from Sri Lanka, said, I have contacted you on WhatsApp. Okay. Okay. Shout outs to everyone in Sri Lanka. Nicole said, I'm having bathing problems. 20% said. 20% for what? I think we have used that already on the capital allowance, and then 25% on the tax rate, Nicole. I hope that's what you are referring to. So that is what happens in the first year. Sweet, simple, straight to the point. So put it down, and then let's go to the second year, and let's look at movement in deferred tax. And where there is movement in deferred tax, how do we actually account for that as well in the financial statement? So put it down, and let's continue real quick. Now, I'm going to post this as well on my Instagram page. So for those of you who are on Instagram, you can follow me. It's the same name here on the channel at Nhyira Premium. And you'll be able to get updates on our lectures as well as these contents there. Any questions, you put it in the thumbs up in the chat box for me. Any questions, you put it in the chat box for me as we build up our knowledge on that. Okay, so now that we are done, let's look at what happens in the second year. What happens in the second year? So in the second year, what do we do? In the second year, what do we do? Now, in the second year, again, we're going to be depreciating our assets. In the second year, we're going to have capital allowance coming in, and then we will find out what is the temporary difference. We will find out what is the deferred tax. Then it will be there that we can determine the movement in deferred tax. So let's look at what happens in year two. So in year two, I'm going to claim this place, all right? So I'll build year two up in this scenario. So depreciation, year two, and it's going to be the same thing as above, 2,500. So in year two, the carrying value of the assets for the year ended 2 will be $20,000. Does it make sense? $20,000. Now, that is the carrying value, but let's look at the tax base of the assets. And then we will be able to find out whether we have, again, a positive temporary difference or a negative temporary difference. So let's see. So let's go here. I'm going to clean this up. So capital allowance for the second year. Remember, capital allowance here is on reducing balance. So it's still going to be 20%, but on 20,000, the reducing balance, the carrying value or the previous year tax base. So 20% of that, that is 5, that is 4, so 4,000. We take it out. And the tax base of the assets will now be $16,000. So the tax base of the assets will now be $16,000. So if the tax base is $16,000, then the question we now ask ourselves is, what is the temporary difference? So let's look at it. So our temporary difference will be equal to the carrying amount, which is the $20,000, minus the tax base, which is $16,000. So that leads us to what? 4,000. Temporary difference of 4,000. Now, again, you are seeing that in the second year, now this is why I said movement in deferred tax comes in, right? So again, you are seeing that in the second year, what are we seeing? We are seeing that there is a positive temporary difference, which means that in the second year, there is also what? A deferred tax liability. So this results into a deferred tax liability. And that's going to be 4,000. And we take 25% of that, and that should be 1,000. Now, this is where you have to be careful. This is where you have to be careful. In the second year, the deferred tax computed, that is not what we take to the income statement. Be careful here. In the second year, the deferred tax computed, that is not what goes into the income statement. Instead, what goes into the income statement is the movement in the deferred tax. Let me take that again. So in the second year, what goes to the income statement is the movement in deferred tax. Now, what do we say? What do we mean by movement in deferred tax? So this is what we do. So we bring the deferred tax. So this is our deferred tax, for instance. We bring the balance brought forward, which is the previous year deferred tax that we had, and that was 625, right? Then the balance brought down, it's increasing now to 1,000. So the balancing figure will become the movement in deferred tax, which goes to the P&L account, and that is going to be 375. So in the year 2's financial statement, the deferred tax that will go into the income statement will be what? The movement, which is the 375. And that 375, because there is increase in the deferred tax liability, it will increase our tax liability. So we will add it to the income tax provision for the year. Assuming it was reducing, then we would have subtracted it from the income tax liability for the year. This is what we mean by movement in deferred tax. Does it make sense? Everybody good? Let me know in the chat box if you have any questions about that. So put it down, and then let's look at the income statement extract and then the statement of financial position extract. Inshallah, Peter, hi, I hope you're doing well. I see you. Andrew Oponbeko, I see you. You are welcome. Chino Abdul said, hello, sir. The deferred tax liability we charge in the income statement, are we to add it to the current year tax and later less it from the profit before tax, or we add it to the expenses? Yes, we add it to the income tax and take the net figure into the P&L account. Okay, so the deferred tax liability doesn't just dump into the income statement like that. No, we add it to it and then we take it there in that case. So you add the liability to the tax for the year and then you less it from profit before tax. So like I said, I'm snapping this and I'll be posting it as well on my Instagram page, so that for those of you who will not be able to copy as fast as possible, you could always get the solution on my Instagram page. So that it will be also available for you. We good? Everybody good with the build up? I see some of you joining. You are welcome to the stream. If you join, consider to give us a thumbs up on the video. But most importantly, if you have any questions, please put it in the chat box for me. Topics you would want me to teach, topics you would want me to cover on the channel. I want to see your thoughts and I want to help you much better. So you put it in the chat box for me. Okay, so I believe you are done now. Yaya Fafana, I see you. You are welcome. Mesiwocho, I see you. You are welcome. Kaif, Mesiwocho. Is that a South African name? Let me know. Mesiwocho, where are you watching from? Let me know in the chat box. Looks like it's a South African name, something like that. Inshallah, Peter said, I'm joining for the first time. That's awesome, inshallah. Monday to Friday, 4:30 p.m. or 16:30 GMT. You can join me on the live stream. And we have also a lot of lecture videos on the channel that you can watch as well. Samuel Kwasin, I see you. You are welcome to the stream. I hope you're doing well. Okay. So now that we've finished, remember, we've got to prepare the financial statement extract. So let's look at the financial statement extract and how we prepare it. For the tax account, we don't need it in our financial statements, right? Because we're not going to be bringing that anywhere. So let's look at a P&L account extract, okay? Profit or loss account, that's an extract. That's an extract for year 2. So what do we bring in the year 2? We bring it in the year 2, and that is going to be, how do we call it? We bring the depreciation for year 2, so under cost of sales, we bring the depreciation there. That's from our workings, and that's 2,500. And then look at it carefully. For the income tax, be careful here. We will only bring the movement, which is how much? We only bring the movement, which is the 625. Sorry, 375. Not the deferred tax we computed for the second year. It's only the movement. Now, assuming in the first year there was nothing, then what we computed will be coming into the income statement, the whole amount, because definitely the movement will be the figure that we had in that case. I hope you get a concept. But because there was an opening balance of 625, the closing balance is 1,000, meaning it has increased by what? 375. So that 375 is what comes to the P&L account. So that is how we prepare the P&L account. Then let's look at the statement of financial position. So in our statement of financial position, that's also an extract as for the year 2. What do we bring? Under non-current assets, we're going to have property, plant, and equipment. Now you're going to write these things in full. Then our carrying amount, 20K, will be brought. Then under liabilities, we're going to have non-current liabilities. Statement of financial position, we will bring the deferred tax computed for that year, which is the second year, and that is 1,000. Now, technically, we are adding the movement to the 625 previously recognized to give us 1,000, which is what is being recognized in the statement of financial position. So this is how we deal with movement in deferred tax, usually in assets. Any questions, let me know in the chat box real quick. Kite Messi Wocho said, I am watching from Cape Coast. Messi Wocho is an Ewe name. Oh, okay. So that is an Ewe name. Okay. Then Ambondelism. Please, will you post the live video on your channel? Yes, this video will be available on the channel after the stream. Okay, so you can watch it again after the stream. Okay, it will be available definitely on the channel. Adele, you see, said, watching you from WA. That is awesome, Adele. Thank you for joining the stream. So this lecture video will be on the channel, so you can watch it, all right? We're not going to take it off. It'll be on the channel so you can watch it. So that's not a problem. So let me snap this. I'm going to post this as well on my Instagram page. Like I said, you can follow me on Instagram at Nhyira Premium, the same name on the channel. And I'm going to be posting all the slides here on my Instagram page so you can take time to write it, or if you're not able to write it as fast as possible. Samuel Quasin said, please, have you talked about when there is revaluation of an asset? No, Samuel, I am about to talk on that right now. So stay with me. In the next few minutes, we'll be going into that. All right. So that is movement in deferred tax. Movement in deferred tax. Now, everything we've discussed so far are the basics. You don't require magical understanding to really look at them. They are more or less like basic concepts we need to understand. But there are some extreme aspects of tax that we need to look out for. And that was a question that someone asked yesterday. And that's the same thing that Samuel Quasin was talking about a moment ago. So let's look at how we deal with deferred tax when there is revaluation of assets. And I'm going to build it up just on this question we have here. Okay, I'm going to just build it up from the question we have here. How we deal with deferred tax when there is a revaluation of assets. So I'm just building it up. Now, let me explain the concept, then we build it up. When there is a revaluation of assets, this is what happens. There can be an upward revaluation or downward revaluation. For the purpose of our presentation, I'm just going to be dealing with upward revaluation, but then I will just explain to you the treatment on downward revaluation. I hope you get a concept. So where there is upward revaluation, entities revalue the assets, but the tax authority does not revalue the assets. So when we revalue an asset, what it means is that the fair value of the asset may be greater than the tax base of the asset or less than the tax base of the assets. When that happens, remember, anytime the carrying amount or the fair value of the asset is different from the tax base of the asset, it results into the temporary difference. That temporary difference leads to what is called the deferred tax. And that deferred tax can be an asset or a liability. But this is where the bump is. So I'm dropping the bump. Make sure you catch it. When we revalue assets, listen to this carefully. When we revalue assets, what happens is that there is going to be a revaluation surplus or revaluation gain. So I'm saying that we're going to be dealing with revaluation surplus. When we revalue the assets, the deferred tax computed on the temporary difference will not be taken directly to the income statement like we've been doing. All that we've been doing so far, any deferred tax, we take it to the income statement. However, when there is a revaluation of assets, then the deferred tax must be splitted into the other comprehensive income as well as the P&L account. How do we do the split? the deferred tax liability or deferred tax asset that goes to the other comprehensive income will be on the revaluation surplus. Then the balancing figure of that will go to the P&L account. Did you get that? Now let's just take the question and then look at how the scenario works in that case. So I'm building up this question and then you get a concept there. So still building on this question, let's assume that in the beginning of the third year, the entity revalued the assets. Okay, so I see a comment from Nicole. Let me look at that if it relates to something I just spoke about. Nicole said, "Sir, can you explain a little more when the carrying value is more than the tax base amount? Why is it a tax liability?" Okay, so we said that when the carrying value is greater than the tax base of the asset, it's a tax liability. So Nicole is asking why. The reason is that the entity is carrying the asset in its book higher than the tax value of the asset. What it means is that on the average, if, for instance, the entity is selling the asset, the entity will sell it at the carrying value. So let's ascribe some figures. So let's say the carrying value is 1,000, but the tax base is what? 800. So that leads to a temporary difference, a taxable temporary difference of what? 200. I get the idea. So when the entity is selling the assets right now, it is assumed that we will sell it at what? The carrying value or at the carrying amount, and that is $1,000. Now, after selling this asset, you need to file for tax, capital gain tax, or pay for tax on it. When you go to the tax authority, the assets that you have sold for 1,000, the tax authority will see the asset as what? 800. So what it means is that in the books of the tax authority, you are making a profit on the assets that you have sold. And the profit you are making is what? 200. That possible profit that you're going to be making 200, it means you need to pay tax on it. That is why it leads to what is called deferred tax. Now, you will say, Nhyira, but I'm not going to sell the assets. Nhyira, I'm using the asset for my business. Yes, we know you're not going to sell. Yes, we know you are using it for your business. But we are assuming the future consequences, should there be any recovering of the assets in that nature, you would have provided for it already in your book. So that is why when the carrying value of the asset is greater than the tax base of the asset, it results into the tax liability. So the reverse is true. When the tax authority is carrying the asset bigger than how much we are carrying it, it means should we sell it, we will be making a loss. When we make a loss, the tax authority will give us tax deductible credit, and that will lead to what is called the deferred tax asset. So Nicole, does it make sense? Do you get a principle well now? Let me know, Nicole, in the chat box if you're good. Now, so let's look at how the revaluation of assets work. So let's say that we are building up this question. Follow me carefully. So if we are building up this question, let's say that in the beginning of year 3, the fair value of the assets in the beginning of year 3 is now $32,000. So the company has revalued the assets, and the fair value of the asset is now $32,000. $32,000. That is serious. So stay with me carefully here. So if it is $32,000, then what do? The balancing figure will be revaluation surplus. And that's going to be $12,000. So that revaluation surplus must go into the statement of other comprehensive income. I hope you know about that. But when there is this fair value at the beginning of the year like that, the entity will depreciate. So let's say that the remaining life of the asset is 7 years. So depreciation for that year is going to be 32,000 over 7. Let's see what we get on that. I'm just building up from the illustration I had in the beginning, okay? So 32,000 divided by 7, that's approximately about 4571. 4571. So we take it out. So we get a carrying value as at the end of year 3 We are assuming that we are not making any annual transfer here under IAS 16, okay? I know you know those things already, but we are not making any annual transfer. So 32,000 minus 4571, that's 27,429, 27,429, 27,429. So this is the carrying value of the asset. But at the end of the third year, what is the tax base? Now, remember in our illustration, at the end of the third year, we were having the tax base coming from year 2 to be 20,000, I guess, because it was 20%, and we took from 25,000. No, I snapped that. Let me just take it from here. Oh, 16,000 rather. 16,000. So coming from year 2, the company has revalued, but the tax authority is still seeing 16,000. But the capital allowance for the year 3 will come in. So capital allowance for year 3 comes in still 20% of the 16,000. And that is by 5. And that is 4. So 0.2 by 16,000. 3,200. So we take it out. So the tax base of the assets at the end of year 3 is 12,800. So follow me carefully here. So if you look at what we've done so far, you will realize that this is the carrying value of the assets, but this is the tax base of the asset. So what do we see here? We see a temporary difference. So let's go. So temporary difference TD will be equal to the carrying value, 27,000, minus the tax base, 12,800. So 27,429, we get some figures up there. So 27,429 minus 12,800, that's going to be 14,000. So the deferred tax liability will be equal to 14,629 times the tax rate, which is 25%. So let's take 25% of that. And that's going to be 3,657, approximately, okay? 3,657. So that is the deferred tax liability. Now, listen and listen carefully. This is where we are saying that this whole deferred tax liability will not be taken to the income statement, okay? So we are assuming that, like everything else doesn't hold, this whole 3,675 will not be taken to the income statement. Instead, it should be splitted between the P&L accounts and then the other comprehensive income. So we split it. But how do we do the split? We do the split by looking at what? How much that is going to go into the OCI, looking at the revaluation surplus figure we had. Looking at the revaluation surplus figure we had. Now, what do I mean by that? So put this down and then let me rub the board so we look at the pieces of that. Put it down and then let's go. Nicole said, wow, perfectly understood. Okay, that's awesome. Okay, so I believe we're good. We can proceed. So remember, we have a revaluation surplus here that is supposed to go to the other comprehensive income. Okay, but along with that, we need to look at the deferred tax liability as well and find out, hey, how much goes into the how do we call it, the OCI, and how much goes to the income statement. So we've got to split the two. So how do we do the split of the two? So let's look at that. So I'm going to clean the slide up here, and then we will look at how we compute the deferred tax that we will allocate into the income statement, and then into the P&L, and then into the other comprehensive income. So let's look at it. So I'm going to clean this guy up here. I need to rub everything because I have a snap on my phone. So let's go. So we'll bring the deferred tax liability computed. And that is how much? 3,657. Then we look at the one that will go to OCI. Okay? So deferred tax to OCI, other comprehensive income. Please follow me carefully. Like I said, the deferred tax that will go to the other comprehensive income will be on the revaluation surplus. So we got a revaluation surplus of 12,000. So that will be 12,000 times the tax rate of 25%. So let's see what we do. Wanted to punch. Oh, that would be times 4, right? So that would be 3,000, I guess. Yeah. So that would be 3,000. So 3,000 will go to OCI, and then the deferred tax that goes into the income statement, P&L. The balancing figure will be 657. I hope it makes sense. So that is how we allocate. That is how we share the deferred tax. Some more question. Let me know in the chat box if you are okay now with the treatment. So this is how we deal with the treatment when it comes to revaluation of assets and there is a deferred tax. Mustafa, Nicole, Jake, okay. Jaden Jake said, nice tutorial. Thank you, Jaden. Some more questions said, please, wouldn't there be an addition to tax base as in an additional of 12,000 before granting capital allowance? No. The tax authority does not grant capital, does not revalue your assets. So they will still be carrying the assets at its initial cost. You did a revaluation. The tax authority will carry the asset at its historical cost. So we will not do any issue about adding it back, claiming, no. Your revaluation is being done in the determination of the carrying amount, but it doesn't affect the tax base of the assets. That is why it is resulting to that bigger deferred tax liability, because you are revaluing your assets. So if you are revaluing your asset, it is going up, but the tax authority will still be carrying it at its cost. Mustafa said, wow, well understood. Thank you, sir. May God bless you. Amen. Oluchi Inowa said, please, where did you get the 12,000 from? Oh, from the workings we did here, we got a 12,000 as the revaluation surplus. Okay, the carrying amount was 20,000 and they revalued it to 32,000. So the revaluation surplus became 12,000. So that is the amount that we are bringing up here, Oluchi. Derek Achina Brantuo, Derek said, sir, please, can you explain the deferred tax on the revaluation amount? Yes, that is what I'm explaining here. The whole deferred tax liability is 3657. But like I said, we need to split it into what goes to the other comprehensive income because of the revaluation and what goes into the P&L account. So we bring the whole deferred tax liability 3657 And then the amount going into the OCI will be the revaluation surplus times the tax rate. The revaluation surplus times the tax rate. And our revaluation surplus is 12,000 times the tax rate 25%, that is 3,000. So these 3,000 will go to the OCI, whilst the 657 will go to the P&L account for the period. Does it make sense? Samuel Quason said, thank you very much. You are welcome, Samuel. Okay. So when you have this like that, you prepare your extract of financial statement, and I've already explained what will go into the extract, and you know that already. So that is how we deal with. Okay, so I see another question there. Nhyira, please. I have really come to understand almost all the standards and even their treatments. I don't want to lose them. What do you advise me to do? What do you advise me to do then? Okay. So continuous practice is very critical. I understand that you are in level 3, and if everything goes on well, you are finishing this year or this time around. And what I would say is that it's a continuous practice. If you have the time, you continue to watch the videos or join my stream or continue to attend CPDs. Institutions organize a lot of master classes on these standards. Deloitte and Touche, Ernst & Young, KPMG, they do some training on standard specific, only that they will be at a high cost to some extent depending on where you are standing, and it could be 1,500 cedis for a session of maybe 6 hours or something like that to go deeper on the practicality on the standards, or you can just be keeping toe with yourself. So even if you are done, you can just continue to study, you can just continue to learn. Then the second thing I would suggest also is that maybe you can consider starting to teach. Okay, so find out if there are some friends you know who are doing financial reporting or even corporate reporting, and they are having challenges with some standards. Find some time, maybe one weekend, meet them on Skype, teach them. Or if you guys can meet somewhere, meet them and be teaching them. As you continue to do that, it retains, or you retain a lot of the things that you have studied, and you will not be able to, or you will not be forgetting about it. So these are the two options that are available. Either you attend, definitely if you become a member, you have to attend CPDs so that you stay updated, or attend other training by the auditing firms, the 4 big audit firms. They do trainings a lot. Or like I said, the best thing I know is to teach. Now, subject to the fact that you are good, okay? There is a difference between knowing and teaching. It's not everybody that is called to teach, all right? There are some people who teach, but you know they suck at what they are doing. It's not that they don't know, but they don't have the charisma, the ability, and what it is. But if you think it is something that you can do, start with your colleagues. Catch them. Free. Don't charge anything, okay? Don't charge anything. For the first 3.5 years of my career, I literally worked to zero. And I was teaching, polishing the skills, polishing the standards, polishing presentation, polishing my thoughts for 3.5 years. So you could as well do that. So I know your friend, you have people who are struggling with some of these standards. So if you understand it, call them. Tell them that, oh, I will do training for you for free. Maybe buy my data for me. That's all I need. If you can buy data for me, we can do some Skype sessions, or come, let's meet here, pay for my TNT, and I will come and teach you, like something like that, so that you will stay updated with yourself. So that is what I would suggest, Samuel Quason, for you. Okay, so Samuel said amen. Yeah, thanks very much. It's always a pleasure, Samuel. Always a pleasure. All right. Any other questions for me? So that is the idea about this. Now, there is another layer of deferred tax, and that is about the issue in relation to dealing with share-based payments, and that is IFRS 2, and that is in corporate reporting specific, IFRS 2, okay, dealing with share-based payments. Then there is also another layer of that dealing with leases of assets. So this is what I'm going to do. This is what I'm going to do. Remember when I was dealing with IAS 16, I told you that there is tax impact on IAS 16, and I'll be talking about it when we are talking about income tax. That's what we've done now. So realize that in the questions we're solving here, we were merging IAS 16, and then we are dealing with the IAS 12 aspect. So IFRS 2, share-based payments, and then leases, I'll be covering these standards possibly later, somewhere later in our discussion. And then when we do that, we will now bring up the deferred tax component in those things. The reason is that I wouldn't want to bring something up that you will not understand, because if I bring leases up and I'm telling you about minimum lease payments, I need to go back, do the foundations with you so that you understand. So I don't want to jump ahead of me. So you hold on here up to where we've done so far. That is what we need so far. But the share-based payments component and then the leases component, when we get there and we are covering those things, I will bring back the deferred tax on those ones. By then, because you have the deposit of the deferred tax, when we are now doing that, it will be much easier for you to understand. So that is what you need to understand about that. Now, there was a question that I wanted to solve with you, but because of time constraints, I will not be able to solve that practical question here. It's on the page, for those of you who have the ICA book, it's on page 48 of the ICA question bank. It was a question I wanted to solve with you. That is SHEP Limited, determining of the tax liability, calculate the deferred tax balance that is required. Per what we did here today, per the understanding you have here today, I can guarantee you that certainly you'll be able to go through that question. And then possibly later on, I'll be touching on some questions throughout on the standards. Now remember, when you're doing one of the standards, another standard comes in. When you're doing one of the standards, another standard comes in. That is why you can't learn and put it aside. Okay, because if you look at it carefully, we are doing tax, but we are going back to IAS 16, deal with carrying amount, deal with revaluation gain, the treatment of revaluation surplus, and that is IAS 16. So you need to know how to marry the standard, how to merge them together so that the engagement party will be well organized, so you'll be able to enjoy the party well. So make sure you get a question, kids, for the subjects that you are writing, because as far as I'm going to be teaching, we're going to be looking at some of the questions in the question kit. So you can look at the question on SHEP Limited, that is on page 34 of the question bank of the ICA, and then give a try to it or on it, and then know what you need to look out for. Now, in case you have any inquiry or you would want to join our online lectures, lectures are on. We started lectures sometime now, and we are continuing for the November 2020 ICA examination. So in case you would want to join and study under my mentorship, join our live lectures via Zoom, and also be enrolled on our study portal where you get access to our full lecture videos, you get access to my ebooks, my question kits, and all of the assistance you need in order for you to pass your exams. Then you can reach us on 050-114-9296, 050-114-9296. If you are really getting value from what we are doing here, then certainly if you join to be able to get access to the full course content, you will be able to be in a better position to prepare well for your examination. So for any inquiries, if you want to join our class or you want to get details on them, reach us on 050-114-9296. Certainly, if you are outside Ghana, that'll be +233. That's the country code. So you start with +233 and then 50-114-9296, and then details will be communicated to you after you do everything, and then you'll be added to our WhatsApp group, and you'll be able to get the meeting details and join our Zoom sessions live with other students studying under my mentorship across the country so that you can prepare well for your examination. So I will conclude here today on our discussion, and then God willing, tomorrow we will continue with something else, you remember to follow me on Instagram, because the meeting details will be posted on my Instagram page every day so that you know exactly what we will be covering for that day. Then you can decide whether it is something that you have to join or something that you will be skipping for that day. Messi Watcher said, thank you. I will WhatsApp you, say. All right, Messi. I'll be expecting your WhatsApp. Okay, so thank you very much for joining the stream today. It's always a pleasure coming your way, providing you with some assistance and enabling you to be able to be in a better position for your examination. Remember, everything we do on this channel is just an introduction. So that is why I recommended that you get the ICA question bank so that you go beyond what we are doing on the channel and practice a lot of questions. But remember, without understanding the concept, you cannot practice questions. So make sure you understand the basic concept, you understand the basic principles. Then when you are solving questions, you will be in a better position in that case. Like I said, in case you want more of these things and study directly under my mentorship, join our WhatsApp group and have me one-on-one in that case, then certainly you would have to consider to enroll in our course, and that will enable you to really get value from what we are doing as well. So thank you very much. I'll see you 4:30 p.m. tomorrow or 16:30 GMT as we continue with our discussions. Shout outs to everybody: Hakim, Mustafa, Oluchi, Christiana Aseidu, Martinez, Gabriel, Domi, Laminos, Francis, Gloria, Moses, Eric, Nicole, Chumesi, Isaac, Nawaz, Yaya, Messi, Wocho, Peter, Samuel Quasin, Yusuf, Jaden. Come on, everybody. Thank you very much for joining the stream. It's always a pleasure coming your way, and I'll catch you same time tomorrow. Until we meet same time tomorrow, take care of yourself, and remember, it is very important to keep on studying and keep on working hard, because it is possible for you to become successful as soon as possible. So put in the work, put in the effort, and you stay blessed. Bye-bye.